If you were out of the equity markets for 2 days?
2 days.
In the past year?
Well, if you looked at the last 20 years,
yeah,
and you took out the best 2 days on average.
Every year?
Every year. If you just missed 2 days on average out of those years, you would have gone from positive equity returns in the United States market of over 7% to nearly negative 3%. That's how severe it is to time markets.
If you tried to time the market,
yes,
and you sold stocks and bought back stocks and you missed the 2 best days of the year.
That's right.
Every year for the last 20 years.
Correct.
Instead of getting 7% per year return positive, you would have lost 3%.
That's right. Using a little rounded numbers. Exactly.
Point is, you need to be in the market all the time because you never know when these big days like we had on Monday are going to come.
So how do you do that? You do that by combining...
Well, don't leave.
Well, you don't leave. That's exactly right. But you combine some safe fixed income in a year like this one, where we have seen bonds rally when equities are set back. This combination of fixed income and equities together gives you less volatility and a safer risk-adjusted return. And it allows people just to see, when they think about drawdowns, we had a drawdown, a weakness of 20% in U.S. stocks, 21% globally last year. If they were in an all-asset class portfolio, even when they had fixed income weaken unusually last year, they were down much, much less, and allowed them just to maintain the discipline of staying in the market and getting those returns. And as you saw this week, we've had all this trade apprehension, all this worry about the Federal Reserve. When you build it up, there can be powerful rebounds in markets you can't be away from.
I guarantee you a lot of our viewers listening or watching right now have the same question. They've owned equities for a while. They've done well. They've made money. They don't want to sell stocks because they want to own them, but maybe there's some tax implications. But they don't believe the kind of gains we've had are going to continue.
Well, that's right.
So how do you mitigate that?
Well, first of all, you can't just say, well, I wish the market were priced like it's 2009 again, right? When people didn't want to invest, and say, we're going to get double-digit returns. The extremely depressed markets of 10 years ago correctly predicted the valuation of stocks then told us we would have double-digit annual equity returns in the United States for the next 10 years. Now, if we take a look at where emerging markets equities are priced, now, current earnings, about 12 times, will tell you that there could be some rough sledding ahead, but the next 10 years will be much better to emerging market equities. The timing of that, probably when we're deep into a Federal Reserve easing cycle, when we get whatever negative news we need to get out of the way, those sustained periods of easy monetary policies when you would get those returns realized.
So maybe sell a little here, buy in emerging markets.
We're raising quality.
I like how you just threw that in there, a sustained Fed easing cycle.
That's right.
Are we going to get the Fed going to cut rates in June, this month?
I think that's going to be a very bad 2 weeks if the Federal Reserve is going to be easing monetary policy 2 weeks from now. The kind of news that we're getting, the fact that the Federal Reserve is essentially arguing that the trade outlook, right, might create negative implications for the U.S. economy, and that financial markets could have negative repercussions for the economy. If that's what they're reacting to, you don't want that to happen. So we're sort of betwixt and between on the Federal Reserve right now. They created the problems for markets last year, creating a great deal of monetary policy uncertainty. The fact that they still, at this moment, are still shrinking their balance sheet, right, is one of the questions that can come up in the next 2 weeks. But for the Federal Reserve to say that right now, this is the time to ease monetary policy, we're going to hear a lot of bad news outside of the Fed for that to happen.
Wow.